بسم الله الرحمن الرحيم. الحمد لله والصلاة والسلام على نبينا محمد صلى الله عليه وعلى آله وصحبه أجمعين. السلام عليكم ورحمة الله وبركاته. Welcome to lecture 2 in corporate finance. Today's topic is about venture capital, how corporations or firms or companies raise venture capital and issue security. Let's start with this introduction. Young firms often require venture capital to finance growth. So, if you have a small firm or you have actually your own idea and you want to start your own business, normally you rely on venture capital. You don't go to a bank to take loans. Why? Because banks will feel reluctant or actually they will be against giving you a loan. Still, you are not a company. You have just an idea. You want to start it. So it is very hard to raise money using a loan. That's why you will rely on venture capital, right? Now, what is venture capital? Think of it as a form of financing for small firms, for startup firms. Okay, so any money that is invested in a new firm, we call it venture capital. And later on, inshallah, we will talk about the different types of venture capital. Now, the issuance of securities is complex process in general that the successful financer must comprehend. So as I said, as a young firm, it is very hard to raise money using banks loans or to issue securities. No one will be interested in buying your shares if you are still a small firm, right? In this case, we will rely on venture capital. So venture capital provides entrepreneurs with financing with money to what? To grow their firms. And if you think of all big firms like Facebook and Instagram, all of them start as a startup companies. They related to venture capital. Then over time, they start issuing share. Firm also issue securities to further finance their growth. This is the second stage. Like in the first stage, you rely on venture capital. Once your company is big, it is established, is there, then you can issue shares and go public. Now, what are the steps to obtain venture funding? The first step, you need to prepare a business plan, which is right. Like if you want to start a new business, you want to offer it to other people. You want to invite other people to finance you, right? The first step, you need to have a business plan. So this business plan include a descriptions of a firm's products in the market. Which market are you going to sell? Is it just the domestic market, or do you want to sell internationally protections methods and resources needed for the success of the firm? So everything about the business, you put it in the business plan. Then the step number 2, you receive first stage financing. So they will give you a small amount of money to start your company. Then they monitor you. If this company is successful, then you move to the third one. You will receive more or subsequent staged financing. So in general, they don't give you all the money in the first step. They will give you or give it to you in different period and state. For example, if you want to start your own company and let's say you need $1 million to start this company, like you ask the venture capital firms to finance your activities. In this case, if they are interested in your business plan, you offer them your business plan. If it is good, like if it's good one, then they will give you, for example, $200,000, not all the 1 million that you required. Like if it is good, they will give you another 200 and so on. So normally for new firms or venture capital, they give you money on different stage. Like our example, 200, and then in the first stage, then maybe they'll give you another 200 and so on. It is not just one lump sum or one single payment. No. Now let's talk about venture capital ownership example. Suppose a venture capital firm offers to purchase 1 million of your firm's shares for $1 each. So here they offer you to buy 1 million shares from your company, each of them $1, which means they are going to pay you $1 million, which is $1 multiplied by 1 million shares. And this will give them 50% ownership in your firm. So this company, they are happy to finance your idea. Okay, they will buy some of the shares in your company, but in return, you need to give them 50% ownership in the firm. The question is, what value are they placing on your firm? In this case, you divide the amount paid by them by venture capital, which is $1 million divided by the ownership, like zero point 0.5. This will give you $2 million, which means this company value your idea or the value of your company as $2 million. They want only 50% of this one. 50%. It means they need to pay $1 million, right? In general, this is a formula. The value is equal to the money paid to you to finance a company divided by ownership. The value of the company. It's like $2 million. If the value is 2 million, they are happy to pay you 1 million in order to have 50% in the firm. Types of venture investors. The first one, we have angel investors. These are investors who finance companies in their earliest stage of growth. As I said, if you want to start your own company, it's very hard to go to banks or to issue shares. The first step, you will check if there are any investor, any wealthy person, or person who are interested in your company. And I guess we see there as many program now on the TV. You put your idea, and there will be a committee, the judge on it. If they like it, they finance your activity. Actually, these are angel and visitors. Like when we say angel, I mean here, it means wealthy people, people who have money. You offer them the idea. If they are happy, they finance it. Okay? This is the first step when you start your startup company. Then the next step, you go to corporate ventures. They name it corporate ventures. Corporations or companies or firms that offer venture assistance to finance young promising companies. Okay? So those companies, they finance you. This is the second stage. If the money here is not enough, let's say you are already started your company, but you want to grow more, okay? Then you need like more money. You go to corporate ventures. Now in Saudi Arabia, if you search on the internet, there are many firms that can finance your activity, venture capital funds in Saudi Arabia. The first one you have, for example, Flat Six Lab. Those guys, they give startup companies. They give them around $10,000 to $15,000 to fund your activities. And for example, they run the program in Cairo, Jeddah, Abu Dhabi, Beirut, and Tunis. This is just one firm. Actually, there are 6 to 7 venture capital in Saudi Arabia. However, so those companies are happy to finance your idea if they are interested in your business plan. So this is actually the second step after you go for angel investors. The second step, you go to this one, corporate ventures. Then another choice, which is the third one, if you need more money, you go to something called private equity investing. They are investors who offer funds to finance firms that don't trade on the public. Still, it is a private firm. It is not in the public, such as a New York Stock Exchange or Nasdaq. So if your company is still small, it's not listed on the stock exchange, they are happy to finance it. Okay. So this is a type of venture capitalist. So now I think we understand what we mean by venture capital. It is money used to finance small firms and startup firms. And there are many types of venture investors like angel investors, corporate venture, and private equity investing. Now let's talk about venture capital management. Venture capitalists are not passive investors. What does this mean? This means they are active. They provide not only money but also provide advice. They like to check with the firm, with you, with the entrepreneurs. They give him advice when day to day operations. So the venture capitalists are able to provide strategic advice, operational advice, financial advice to companies based on past experience. Normally, they have experience, those venture capitalists. So they give you their experience, and this is a very important point. They are not passive. They are active investors. On other hand, if an investor wants to buy, let's say, shares in one of the companies, we call them passive investors. You buy the shares, then you leave it. Once the price is going up, you sell it. This is passive. But those guys, they go in the management. They will be in actually some of them will be a representative in the management team, and they take care of decisions. Okay, so what do they provide beyond financing? They give advice based on their experience. They give strategic, operational, and financial advice to startup firms. Now let's talk about the initial public offering. When a firm requires more capital than private investors, like then private investor can provide, it can choose to go to public through something called initial public offering, or we call it IPO. As I said, if you have an idea, first of all, you ask wealthy people to finance your activities, right? Then the next step, you go to venture capital firms, then private equity firms. But assume now those funds are not enough for you. Then you need to go to public, which means you need to issue shares for your company, and your company will be listed on the stock exchange. All investors will invest in your company. In this one, we have two-time primary offering. From the name primary, which means the first one. This is when the new shares are sold to raise additional cash flow for the company. So, the first time the company offered its shares to the public, we call it an initial public offering. This is the primary. This is the first time the stock will be listed on the stock exchange. And when you issue those new shares, definitely you will receive money as a company. This is the first. Then you have a secondary offering. This is related to the situation when the company's founders and venture capitalists cash in, like on some of their gains by selling shares. Imagine if you started, let's say, a new company, and this company grow over time, And definitely you have some people with you, like let's say your relative, let's say one of your relative is a wealthy person and he invested in your company, and you also took some fund from venture capitalists. Now if those venture capitalists are founders, they want to exit the company, they want to sell it, they can do it and make some cash, right? So they will sell the company in the market and they will cash out some of the money. And many people, they are doing their idea actually to reach this point. So you start a new idea, start a new company. Once a company grows, you sell it and you take the money from that one. And I remember there was an example for WhatsApp. WhatsApp in 2014, Facebook bought WhatsApp for 19 billion. Imagine. So there was one guy who put the idea for WhatsApp. He was working on that one. It was a startup company. Then in 2014, he sell it. And he definitely, there are some founders with him or some venture capitalists. So he sell it. So this is, we call it cash out. So he start the idea. Once the company grows, and he sell it and cash out some of the money. Now, for the secondary offering, does a secondary offering provide additional capital to the firm? No. So when you sell it, the benefits will be the founder and venture capital list, not to the firm. The firm will be owned by another firm. And this is actually the difference between secondary and primary. Primary, when you issue shares, all the money will go to the company to grow. But for the second one, it's like you sell the company to other investors. Now, what are the benefits of going public? Which means, like you list your company on the stock exchange. The first benefit, ability to raise new capital. So when you issue shares, definitely you raise money, and you will raise a large amount of money, more than what will the individual will give you, more than the venture capital. So one reason why most of the companies go from private to public is to raise money. Same if you have a family business and you need a large amount of money, like in millions. One way to raise those funds is to go to public. You issue shares to the public. So this is the first benefit and actually the main reasons. Another one, stock price of your company provides performance measures. So when the company goes public, this will make some pressure in the management to perform well. Why? Because there is a stock now is listed in the stock exchange. So as a manager, you will day and night think of this price, right? Because you need to make sure the price is up. So the price reflect the performance measures for the company. So think on it. If you have a family firm, you don't have too much pressure from the investors, right? But when you issue shares, everyone will check the share price. You will have more pressure to perform or to perform well for them, for the sake of the stockholders. Then we have the last benefit of going public is that information is more widely available. When you list your company in the stock exchange by law, you need to issue financial statement at the end of the year. Like there is a 4 or 5 financial statement. You issue them, and this will provide more information about your company compared to a private firms, or a family business firm. Also, going public help in diversified sources of financing. So instead of raising money only from banks, you will raise it from bonds. You can issue bonds, you can issue a share. So here you have different sources, and this actually, at the end, this will reduce your cost of capital. So the cost of raising money from different sources will be lower than the cost of raising money only from one sources, which is the next point actually. This will reduce your borrowing costs. So it's known in real life. Most of the companies use a mix of debt and equity to finance their activities. None of the companies use only debt or equity. You need a mix of those components, and this will give you the lowest cost of capital. Arranging public issue. Now, let's go through the process. What is going on through the process? Okay, so we will now go through the steps to issue new public security. When we say security, it means shares. How to issue shares? First of all, you need SEC registrations. Okay, so this is a Security and Exchange Commissions. You need to register with them and issue something called a prospectus. This is a formal summary that provides information on an issue of securities. So think of this document as a legal document that summarizes all the duties and responsibilities of the company. So this will give you more details about the issue about the share. So this is the first step. The company will issue the prospectus to the public, to people like me and you. Okay. Then the second step, the company will select an underwriter, or we call it undertake roadshow. This is actually an investment bank, an investment banker. So the company will hire a bank to do the issue for them, to issue shares for them. So the investment bank will manage everything. First of all, he will check if the public is interested in the firms or not. Then he will sell the shares for the public and collect the money. Then at the end, he will transfer it to the firm. The third step is to set the final issue price of the public. So assume here they just hired the bank. The bank will advise them what is the best price to issue a share. And this is one like of the most important decisions. When you are a private firm and you want to go to public, the most difficult decisions is to set the price. How much to sell the new shares? Because it has never been traded before in the stock exchange. You don't want to put it too much high or too much low. You need the appropriate price, and the underwriter will help you with the best price. Here we have the IPO flowchart. So this is how it goes. The first step, we have the underwriter, or think on it as a bank, investment bank, and this is a firm that want to issue shares. Step number one, underwriter provides advice to the firm. They give them advice to the best, or in the best price when to go to the public. Should we go public now or in 1 month? Whether the public or people are interested in the company or not. This is step number one. Step number two, underwriter pays a firm for a number of shares. Now, the underwriter, once they agree, they have the agreement. The investment bank will pay for the firm specific amount of money and buy the shares from them. Step number three, the firm provides the shares to the underwriter. So they agreed. This guy will pay a money, the underwriter and the firm will give them the shares. Step number four, underwriter will offer the shares to investors, to the public, because the bank itself is not interested in the company. He just bought the shares to resell them to the public, which is step number four, to investors like me and you. Then, step number 5, investor purchased shares from the underwriter and paid the money for the underwriter. So it is very like simple process. You give them advice, you pay them the money, take shares, then resell it again like in the market and receive the money from investors. And definitely here like there will be some profit for the investment bank. We will talk about this one in the next few slides, inshallah. Actually, which is this one? There is something called underwriter spread. So, what is the idea here? Spread is the difference between the public offering price and the price paid by the underwriter. So we know the underwriter when he sell or resell shares in the market, he will sell it at a higher price compared by the price paid by him to the company just to make some profit, right? This difference we call it spread or underwriter spread. Let's like take this example. Assume the issuing company incurs 1 million in expenses to sell 3 billion shares at $40 each. So this company, they want to issue shares. They sell it at $40 each to underwriter. This is how much they charge the underwriter. Then the underwriter sell the shares at 43. He sell it at a higher price. And the question, what is the spread? The spread is the difference between those two numbers. This underwriter sell it for $43, right? But he paid for the company $40. So the difference is 3. This is a difference is 3 per share for every share. The profit for the underwriter is $3. Like now, how many shares he have? 3. So the spread will be 9 million. It's like the underwriter received 9 million from this process. He bought the share at 40, he sell it at 43. The profit is $3 per shares. We have 3 million shares, multiply by 3, it will be 9 million. Now let's talk about the difference arrangements. We call it underwriting arrangements. There is 2 types. The first one, firm commitment, means underwriters buy the shares like first from the firm and then resell it to the public. So this means the underwriter itself is responsible about selling all shares. For example, if the company want to issue 1 million shares, the underwriter will buy all shares like the 1 million from the company and they will resell it in the public. If they couldn't sell all of them, let's say they sell only 800,000, not all the 1 million, just 800,000. The responsibility of the remaining is underwriter. He have to buy it. He is forced to buy the remaining because this is based on the agreement. We call it firm commitment. So the underwriter will guarantee the firm he will sell all the shares. If not, he will buy it for himself. Okay. Best offer commitment. From the name, best offer. He will do his best, whatever he can do. Then, if something remained, then there is no guarantee for the sale of the shares. Here, underwriters agree to sell as much as they can of the issue as much as possible, but they don't guarantee the sale of the entire issue or all shares. Okay? Again, if the company wants to sell 1 million, he will help them to sell it. But there is no guarantee they will sell everything. Actually, it depends on the market. If they find enough people to buy the shares, that's done. They will sell the 1 million. If they cannot, they will sell just as much as they can. So here, there is no commitment on the underwriter, but the first one is more commitment. Okay, let's take this example. How much will a firm receive in net funding from a firm commitment underwriting of 250,000 shares priced to public at $40? If a 10% underwriting spread has been added to the price paid by the underwriter. Additionally, the firm pays 600,000 in legal fees. So, here we want to calculate how much fund the company will receive. Net fund after we deduct all fees, all legal fees and other fees. The type of the agreement here is a firm commitment agreement, which means the underwriter will take care of everything. Now, how many shares they want to issue? 250,000. Okay? It's priced at $40. This is for public. So the price for public is $40. But the tricky thing here, they mention here is 10% spread for the underwriter. Now, to figure out how much or to calculate how much the company received from this $40, like we simply divide the 40 by 1 plus the underwriter spread. This is a formula always because here they don't mention to us what is the price for the underwriter. We have only the price to public. To find out how much the company received from the underwriter, it always equal to public like price divide by 1 plus spread. So in our questions, it will be the public price 40 divided by 1.10, and this will give you 36.36. Now, what does this mean? 36, like 0.36. It means the company only received $36 from the underwriter. Then the underwriter sell it, like in the market for $40. Now, we don't care about how much he sell it, okay? We don't care about the $40. We are caring here about the firm, how much the firm received. They received only $36.36 for each share. Now, how many shares they have? 250, right? 250,000 shares. Each shares they sell it is like 36.36. It means they were able to raise $9,090,000 from selling their shares to the underwriter. But this is not the net. This is how much they received. Remember, there is some cost here or fees removed, the expenses or the fees. 600. The remaining is 8,409,000. So this is the net amount of money the company received from selling the 250 shares after deducting the fees. Okay, so this is how we do it. Okay, it's a bit tricky, but always follow the formula to find the correct price. Okay, let's move. There is another concept called underpricing. Okay, underpricing of like an IPO. Underpricing means issuing securities at an offering price set below the true value of the company. So as I said, because this company never been public, the first time you want to issue shares, it's very challenging to set the price. Most of the times, the underwriter or the bank, they set the price below the true value because they want to make sure they can sell all shares. So they reduce the price to sell all of them. This is like we call it under the pricing. Like under pricing is basically you issue the shares and you are offering a price will be below what it should be. Okay? In order to sell all the shares. Like for example, assume the issuer incur 1 million and other expenses to sell 3 million shares at $40 to underwriter, and underwriter sells the shares for 43. It's like the same example that we took. This firm, they issue three shares. They sell it at $40 for whom? To underwriter. Then this underwriter or the bank sell the shares in the public for how long? For how much they sell it? For 43. Now, assume by the end of the first day's trading, the issuing company stock price had raising to $70. Now, imagine by the end of the day. Now the issue, the shares are 30. There was trading people like buy and sell in the market. The closing day at the end of the day, the price of the share goes to 70. Now, this means the underwriter here was wrong when he said it is 43. He sell it lower than what it should be because the market they value the share at 70. What is the total cost of underpricing? It is clear here we have underpricing because the price in the market, the true value is higher than what was the offer price. If you want to find exactly how much they lost this amount. It should be 70, but they said it is 43. The difference. This will give you the difference for each share multiplied by 3 millions. So here they lost 81 million, which means they could sell it at 70 instead of 43. Now, because they sell it for 3, it means they lost $81 million. That's why actually determining the price of an IPO is the most important decisions. And that's why the firm hired the investment banker or banks to do it for them. Now, let's talk about another concept called floating cost. Floating costs are the costs incurred when a firm issuing new shares to public. When you issue the first time shares to a public, you will have some cost. We call it floating cost. Example of floating cost are underwriting fees. When you hire the investment bank, they will charge you some fees, right? There is also some legal fees. For example, you need to issue the prospectus. We just covered it before. This is a legal document. This will cost you money. Same for registrations fee. When you register in the stock exchange, there will be some registrations fee. Okay, let's move to types of offering. So let's say now the company already in the public IPO. Okay, done. We finish after the initial public offering. Successful firms may issue additional equity or debt. So as I say, the first time you issue shares in the market, you issue shares, you raise money, and let's say after 5 years, the company needs more money because they want to grow bigger or to become bigger. In this case, we call the second shares called seasons offering. We call it seasons offering. Here you have two types. One right issue, basically they issue of securities offered only to current stockholders. So assume now the company, they already in the stock exchange, they want to raise more money. they will issue new shares, but the priority will be to the current shareholders. So this like we call it the right issue, which means the current stockholders or shareholders, they have the right to buy the shares first. The other one called general cash offer. So this is a sale of security open to all visitor by an already public company. So first of all, normally companies they make right issue to the current stockholders if they are not interested or if they cannot buy all the shares that the company wants to issue, then they offer it to everyone in the market. Okay, we have here one example. This is for the right issue example. An investor exercising his right to buy one additional shares at $20 for every 5 shares held. The question is, how much should each share be worth after the issue or the right issues if they previously sold for $50? So, what's the story here? We have one investor. He already have shares in the company and the company wants to issue new shares. Now, he has the right to exercise his options. He has the right to buy the shares. Okay? Now, if you want to buy the new shares, the contract says you can buy one additional shares at $20. The new shares, you can buy it at $20 if you has already like high 5 shares in the company. So if you own 5 shares in the company, this will give you the right to buy only one new shares and so on. Because they want to distribute for everyone, right? And the questions now, what is the price of the shares after the issue? Okay, after the issue, what will happen to the price? If the previous price was 50, here you have two things. You have pre-right issue and post-right issue. Before they issue the new shares, as the question mentions, each shares was at $50. So $50 multiplied by 5 shares, because I assume now he own only 5 shares. The price will be 250. This is a total. This is before he buy a new one. He have 5 shares, each of them 50. This means 250 the cost. Now he is like exercise his right and now he owns another share. It will be like the old one 50 multiplied by 5, 250. Then he has one, and you shared at 20. It is $20. The total cost here is 270. This is 270, the total cost for everything. If you want to see what is the price per one share, okay, this is price for how long? This 274, it's for 6 shares. If you want to, like for one share, divide it by 6. It's like now the price is $40, 45 each. So the total cost for him is $270. You have 5 plus 6 shares. Each of them, it's like $45. This is how we calculate the right issue. You always follow 1, 2, 3 steps. Calculate it before you calculate the cost. After then the last step, you divide the cost by the number of shares. Now we have here general cash offer and shelf registrations. What does this mean? Shelf registrations. It's a procedure that allows firm to file one registration statement for several issues of the same security. As we said before, in order to issue shares, first of all, you need to register them. Register them with the government or with the Securities Exchange Commissions. There is one way called shelf registrations. This will allow you as a firm to just register one time, and this will allow you to issue many times. You issue shares for different times for several issues. You can issue this year, next year, and the year after without going again and register and register. So these registrations will give you the right to issue several issues of the same firm of the same share. Now, what is the benefit of this shelf registrations? Security issuance without excessive cost. So this will reduce your cost. You don't have to register every time you want to issue the shares. Security issuance on every short notice. You can issue at any time because it's already registered. So no need to go through the process again and again. Number three, timed issuance to specialize on favorable market conditions. As I said, you can issue it at any time you want. If you feel, for example, the market today is up, it's good to issue shares at high price. You can issue it because it's already registered. No need to go through the approval again. And the last one, additional underwriter commission. Another way to issue shares called private placements. So, from the name, you offer your shares as a company to private people, to specific people or companies in order to avoid registrations with the SEC. A company can issue a security privately, which we mean by private placement. It means the sale of securities to a limited number of investors without a public offering. So you can say here we have two choice as or choices as a company. The second time you want to issue the share, you can issue it to the existing shareholders, the current shareholders, or you can offer it to everyone in the market, public, or you can do it something called private placement. You offer it to specific investor or specific firms. Normally, insurance companies are interested in buying shares. Sometimes we offer them. If they want to issue shares, you just issue to specific company and they will buy it for you. This is we call it private placement. Now, what are the advantage of a private placement? A private placement don't have to register with the SEC Security Exchange Commissions. Private placement costs less than public because no need to do the legal documents and all of those things. A contract can be customized for each investor. So you can do the issue specific for your customer, for a specific company or specific investors. Okay, disadvantage is difficult for investor to resell security in the future. So let's say you offered your shares to private company and they bought it. In the future, if they want to resell it, it will be more difficult than the public shares because they are not public now. It is a private one. Okay, lenders. Lenders means investors or banks or anyone require higher return to compensate for high risk because the private investment is considered riskier than the public offer. So private placement typically yield at 0.05% higher than the public issue. So this is the third method. So you have a right issue or you issued a public or a private placement. Okay, this is all for this chapter. Thank you very much, and if you have any questions or concern, please feel free to post it in the blackboard and I will answer it inshallah. Assalamu alaikum wa rahmatullahi wa barakatuh.